everyone. Rachelle Vanderzanden here with Corey Janoff, as always. I'm going to say hi, Corey.
Everyone.
There we go. Today we're going to talk about an exciting investment topic, which is called tax loss harvesting. So I don't know if any of you have heard of that before. I think in our episodes a couple of times we may have said, Google that. But instead of having you Google it today, we're actually going to talk about it and explain a little bit about it today. Basically, the idea is that when there is market volatility, sometimes that can provide advantages in your taxable investment accounts. And by market volatility, we're kind of using that as a code word for pullbacks in the market where you lose some money. But that can be advantageous in some situations. And we're going to talk a little bit about how you can basically trigger some losses in your accounts to offset gains. It can be pretty, we don't want to encourage people to do this without care. Obviously, it's very important that we're approaching this carefully. And it's also, this is not particular advice for your situation. This is not tax advice. If you're going to do something like this, definitely, talk to your CPA, talk to an advisor, someone like that to actually implement it. But we did want to give you guys an overview. We also have someone with us today, Zach Kill, who works for our firm. He is a CFA, and Corey is going to introduce him and talk about him a little bit for you.
Yes, thank you for joining us, Zach.
Yeah, thanks for having me.
First and foremost. And yeah, CFA stands for Chartered Financial Analyst, or I like to prefer it as Certified Freaking Awesome. And basically it means Zach knows way more about investments than you or I ever will. Now, you may be wondering why I would not know much about investments. Well, I wouldn't say not know much. I know a decent amount, but think of me as like a general surgeon. I'm not also going to give you anesthesia. Let's bring an anesthesiologist in for that component of it. So we're fortunate here at Finity to have multiple CFAs on staff to help us with our investment management and make sure we're doing the best job for our clients. But Zach, why don't you give us a little humble brag here and tell us the steps involved to passing the CFA exams and obtaining that certification?
Yeah, so it's a 3-step process. There are 3 tests. Level 1 is focused more on broad investment topics, just kind of going through do you know what these things are? Level 2 is a lot more math-oriented, a lot of formulas. It's a lot of discounted cash flow, just different valuation methods for both bonds, equities, everything like that. I think there are around 260 formulas to memorize on Level 2. Level 3 is more broad financial planning focused, so that talks about suitability and how to put together portfolios for clients.
Awesome.
But yeah.
And it takes a minimum of 3 years, right? They only offer that each level once per year.
Yeah, so they offer level 2 in June and December, and they offer level 3 or 2 and 3 in just in June. So if you fail it, you have to wait a year in between to do it. And I think the pass rate for level 1 is about 42% of people to take it pass. For level 2 is about 46, and I think for level 3 it's 52.
Do you know the odds for, if you pass the first one, what the odds of you getting the next ones?
Yeah, so I know that only 10% of people pass all 3 tests in the first shot.
Okay.
Wow. So yeah, that's a tough one. I think the kind of the holy grail is the 18-month turnaround on it, where you can take level 1 in December, take level 2 in June, and then take level 3 the June afterwards. And I know one person that's done that, but very difficult.
But yeah, I think you did them 3 straight years, right? And
yeah, I did it. Took a couple. I didn't pass level 2 the first go around. Was close, but didn't pass it. But yeah.
Regardless, you've been put through the gauntlet and came out alive on the other end. So Zach knows his stuff when it comes to investments is what we're trying to get across, so we should listen to him.
I have Zach on speed dial. I call him almost daily just to run things by him, just to chat with him and have another set of eyes on things, for sure.
Yeah, super helpful when we have questions about investments for our clients' accounts. But like Rachelle mentioned earlier, we want to talk about tax loss harvesting today, which is a somewhat technical concept, but for those of you listening, most of you are going to be in pretty high income brackets, which means you're going to be in pretty high tax brackets, and this can be a beneficial strategy to utilize when presented to lower your tax bill. And everyone loves lowering their tax bill. In a perfect world, we would never have losses. We would only have gains, and everyone would be happy. But
we'd be happy to pay taxes because we only have gains ever.
Exactly. But unfortunately, the world isn't perfect. We have ups and downs in life and in the stock market. And when the stock market does deliver some of those downs, not ideal from a I guess, performance metric, but it is beneficial from a tax standpoint, and you can use those periods of volatility to help reduce your tax bill. So, Zach, why don't we start off just so people understand the nuances a little bit of how investments are taxed. So I guess what type of investment accounts are actually subject to capital gains taxes?
Yeah. So the main accounts that are taxed are non-retirement accounts. So anything that's not a Roth IRA, SEP IRA, anything without IRA in the name for it,
Or like a
or
401k.
401ks. Yeah. And so usually that's either an individual account, a joint account, trust accounts, things like that. And really, it's the accounts that you would get a 1099 for that you'd expect to pay taxes every year on. But yeah.
And then, within those accounts, you have unrealized gains and realized gains. And can you talk about the differences in those and what are actually subject to taxes?
Yeah, so with capital gains taxes, they're only assessed on realized capital gains. So you realize a gain once you sell the position. So at any given time, you have gains or losses in all the positions in your account as long as they've moved at all. So if you have a position that you bought for $100 and it's worth $101, then you have a $1 gain in it. That's not taxed. It's only taxed if you were to sell the $101, and then you'd be taxed on the 1% or the $1 difference between 101 and 100. And so that would be your realized capital gain.
Yeah, I like to explain it when you actually have the opportunity to put cash in your pocket. I mean, most people will just reinvest, or they're selling a security to buy a different one. But and you don't have to pull the sell trigger yourself either, right? Like it could be if you own a mutual fund and they make some adjustments and sell positions that can trigger a capital gain for you.
So that is one of the difference between mutual funds and ETFs, where those capital gains distributions are sent out from the mutual funds, where with ETFs, it's the way that they're structured, they tend to not spit out capital gains distributions. And so usually those capital gains distributions for mutual funds happen at the end of the year. So that's one of the reasons why you could do tax loss harvesting to offset any of those distributions that you can't do anything about.
Perfect. And then I think one thing that's important to note is that capital gains taxes are a little bit different than income taxes. So like there's long-term capital gains and then there's short-term capital gains, which is kind of the same thing as ordinary income taxes. But can you tell us a little bit about the long-term capital gains and when that comes into effect?
Long-term capital gains are realized gains for positions you've held for more than 12 months. And then that's on a per tax law basis. So if you were to buy, if you bought part of your position 6 months ago and bought part of it now, the part that you bought 6 months ago would turn into long-term gains 12 months from when you bought it, and then what you bought today would be 12 months from today. So you can break it down and get pretty detailed with what you're actually realizing. For short-term capital gains taxes, they're taxed as income, like Rachelle said, and long-term capital gains taxes it fluctuates depending on your income. It usually is between 15 and 20%, and then if you're in the top income tax brackets, there's also an extra 3.8% surcharge on there. So it's really between 15 and 23.8% is what your capital gains tax is.
Just federal, so you could have additional state on top of that. So a lot of you guys will, at the very least, probably be in 15% plus the 3 point whatever, and a good chance you'll dip into that 20% range too, which right now, I mean, do you know much historically about where capital gains tax rates have hovered or fluctuated?
Yeah, I think 15% was, I mean, I know before, I think there were some recent changes that bumped up some of the other brackets up into that 20 to 23% range. I think that actually had to do with Obamacare.
Yeah,
and that got passed. Yeah. But before that, I think it was just a straight 15. Don't quote me on that.
And I think in the 90s, during the Clinton years, I want to say the top one was even like close to 40%, if I recall.
Yeah, it wouldn't shock me. I mean, tax rates in general have come down a lot over the past 20, 30 years.
So anyways, just like income taxes, capital gains tax rates fluctuate over time.
Yeah.
So, and then we've got short-term gains, long-term gains, and then also if your investments go down in value, short-term losses and long-term losses. And I guess kind of what's the order of operations for how losses and gains interact and potentially offset each other.
Yeah, so I think the main thing there to keep in mind is that the benefit of tax loss harvesting is you are able to harvest the losses that you have, and then you can use those to offset gains when you realize them. And so with that, you have short and long term on both sides. Typically, they offset like to like. So short-term gains short-term losses will offset short-term gains. Long-term losses will offset long-term gains, and then if there's any left over on either side, then they will go to offset whatever else is left. And then if you have leftover after that, you can use up to $3,000 a year to deduct from your normal income taxes.
And it's not like a straight tax deduction; it reduces your income. Is that correct?
Yeah.
Okay. Perfect.
And what if you have like 10,000 of losses at the end of the year, but you can only use 3?
Yeah, so you can use 3. I think one of the things that people get mixed up on is that you can use an unlimited number of losses to offset gains in a given year, but you can only use 3 to deduct against income. If there's anything left after that, then that would roll forward to the next year, and the whole process starts again. So if you had new losses accumulated in the next year, you would add those to the ones that were rolled forward, and then you'd go through and offset things. And then,
Or if you had gains, like if you have 7,000 that, in that example, 10,000 in net losses for the year, you're writing 3 off your taxes. There's still 7 unused, so you could offset 7,000 of gains the following year potentially. Yeah. Mm-hmm. Okay, cool.
Who's in charge of keeping track of all that?
Who's in charge of keeping track of all that?
it depends on what you do there. I believe some of the tax softwares that people use, or the software programs, they will keep track of your accumulated losses. The main issue there is that if you switch tax providers or something like that, you'll lose that information. It's still possible to go track that stuff down. I know for us, we have that information saved a couple years back just automatically. But a lot of times it's up to the financial advisor to keep track of that information, or you if you're managing things on your own.
Yeah, just make sure that you're keeping good notes on your end too if you do something like this. Absolutely.
Yeah.
If you work with a CPA for taxes, they should
do it.
Be tracking that for you.
Yeah, if you have a dedicated CPA that you go back to every year, that should be the person.
And maybe walk us through an example of how someone would actually go about successfully harvesting losses in their accounts.
Yeah. So I think one of the main limitations that people need to be aware of, maybe it's good to go into wash sales first a little bit.
Yeah, perfect.
Yeah, so one of the limitations that the government has set for tax loss harvesting is the wash sale rule. So what the wash sale rule is that you can't sell something at a loss and then buy the same thing or what was the term that they used? Substantially equal investment with those proceeds within 30 days, either before or after. So if you do that, then the losses are basically canceled out. Technically, they would roll forward, and so whenever you sold the other position, it would roll into that. Not really sure how the tracking goes for that, but typically just avoid wash sales because they don't benefit you. And so, some things that would be wash sales is a lot of it, the substantially equal is a really tough. There's not really a good definition for it. I know for me, I'm not comfortable with, if you own like an S&P 500 mutual fund, I'm not comfortable with selling that mutual fund and then buying another brand of S&P 500 mutual fund. I feel like that's a no-go. Another thing that you could potentially do instead of that is pick a different index. So, I mean, if you use the S&P 500, you could also use the Russell 1000 or like an MSCI index or something like that. Something that's different. From an index standpoint, for active funds, you can pretty much avoid wash sales just because it's going to be a different strategy. So there are some risks to that we can get into, but typically it's just you don't want to buy the same thing. Also, if you're buying like a stock, or if you're offsetting or if you're realizing losses in a stock, you don't want to buy that same stock again within 30 days.
Probably the most straightforward example.
Mm-hmm. Yeah. I wasn't sure, honestly, if we could talk about
we can talk about
like stocks in there, because I think a good example would be like Coca-Cola and Pepsi, where they both do similar things. So what you could do is you could harvest losses in Coke, and then you could buy Pepsi in the intermediate term, just in case for that sector or that business just in general does well. Then you remain invested in the asset class, and then can hold that for 30 days or whatever you want to do, and then switch back to Coca-Cola.
I know.
This is not a recommendation to buy or sell Coke or Pepsi stock. This is just an example of two very similar companies. So, compliance, don't be mad at us.
Zach, I know you didn't get to the question yet, but I'm going to take like one step back, because I think the important thing for people to realize here is that when we sell, in order to trigger losses, we want to lock those losses in for tax purposes, but not for investment purposes, which is why we go back in and then we reinvest that money that we just sold. Yeah. Because there's a lot of like, when we're in a really, really volatile market, people maybe panic and they want to sell because they want to get out. Like, that is not the goal here. The goal is to sell, trigger losses for tax purposes, but get yourself back into the market immediately. Yeah, in something else, because that's the rule. That's the thing that we want to avoid, is just not putting your money back into something that's exactly the same, because then the IRS is like, what are you doing? Basically.
Essentially, you want to be as close to the same investment as possible without being substantially the same asset.
Right, because your risk tolerance hasn't changed, I hope. Like, we're still trying to accomplish the same goals. We're just trying to, do some things to help with the tax bill along the way.
So, like, a good example of issues you could have there is specifically with the COVID-19 situation, value stocks have been beaten up pretty badly, and so what you wouldn't want to do is sell a value stock and then go buy a growth stock to do your tax loss harvesting. You'd want to buy another value stock. Yeah, exactly. So you want, if something is underperformed, you want to buy into something that's similar and is also underperformed, rather than going it the other way and buying something that's outperformed. And if you're dealing with mutual funds or something like that, you want to keep the same risk profile overall.
Yeah, the goal is not to really change your investment objectives. It's just to, let's use this, law, regulation, whatever, to minimize our tax bill legally.
If you think about it, I mean, one of the benefits of it is, I know there were some mutual funds, for example, or some indexes that were down at their probably 2015, 2016 levels. Some were even lower than that, where, you've accumulated gains potentially over that entire period, where it essentially lets you to harvest all those losses, and you can offset, it almost lets you offset the gains over that time period, where if the market recovers, then you've essentially just canceled out the gains that have accumulated over the last 3 or 4 years. It's a big if things do recover, but over time they have, so it does help offset your gains.
Absolutely.
So, just to we kind of went all over the place right there, but just to kind of clarify, so for someone that, let's go back, between when this is being recorded in July and when it gets released, probably August or September sometime, who knows what's going to happen in the market. But if we were to go back in time to, say, March of this year, when the market just dropped by 30+% in 4 weeks, that was, a decent opportunity to, if you're using your S&P 500 example, you sell your S&P 500 fund, buy a Russell 1000 fund. Essentially, you're staying invested in the same things, large U.S. company stocks. Exactly. The Russell 1000 has like a broader spectrum, but still, for the most part, the similar names. And then you've locked in whatever your losses were from that S&P position. Okay. And then after the 30 days, to avoid the wash sale, would you then go back to the S&P, or do you just leave it in the Russell? Or what do you look for?
Situation. So for me, I think, you can harvest losses on both index funds and actively managed funds. I prefer, I think the top priority would be index funds, because it's easy to stay in something that's similar without having the risk of maybe maybe the active fund underperformed, but it'll outperform on the upside or something like that, just because it's going to be invested. Every fund is invested differently. Where indexes, at the end of the day, if you buy large U.S. companies, they're all going to perform in aggregate about the same regardless of which index you're in. So with index funds, I don't have a problem if the market recovers and you're going to all of a sudden have a ton of gains in the new fund to just leave that in there for the time being. You don't really need to, there's not an urge to sell it and replace it. If there's a fund, for example, like an actively managed fund that we just really like the manager, it's just a case-by-case basis where if we want to get back into that fund because we trust them over the long term, then we'll probably look at it depending on what the capital gains are. In March, I mean, the big thing was we had a quick recovery from the lows. And so if you tax loss harvested at the lows, you're going to have significant gains in whatever the replacement fund was. So it's just kind of a case by case basis on how much you like the fund that you replaced it with compared to the original.
Because then if you sell that, then you've triggered a whole bunch of gains.
And then you've undone what you just did.
Right. Because then if you sell that, then you've triggered a whole bunch of gains,
And then you've
which
undone what
completely
you just did.
exactly.
Mhm.
And so I think it is important that when you're replacing the investment that you sell, that you pick something that you're comfortable with.
Mhm.
Because if you put something in there that you're not comfortable with,
Yeah.
and you feel like you have to sell it, like obviously it
Mhm.
limits your choices.
Exactly. So you should like the replacement fund as much as you like the original fund, hopefully. Maybe if not exactly the same. I guess that could be a reason not to tax loss harvest something. If it's a unique fund that is doing its own thing that you can't find any good replacement out there, maybe you hold on to that one. It just kind of depends on what the losses are. And I think a good example or a good thing to think about is, I mean, if you're already realizing a large amount of losses in a given year, maybe you don't need to harvest. Like if there's one position that you really want to hang on to, maybe you just leave that one alone. You don't have to get everything all the time. It's just more of a cost-benefit analysis.
That's the more you know. So if someone harvests a bunch of losses during the year, say spring of this year, they were smart, they were paying attention, they sold when the market was down, reinvested. Now they're sitting potentially on some gains. We're coming close to the end of the year, and they've got all these losses that they're sitting on. Do you potentially look at selling positions at gains and use those losses in this year to offset the gains, or what do you usually look at or do?
I think it depends. So, like, if you have the losses accumulated at the end of the year, I don't necessarily look to just realize gains for the sake of realizing gains. I still like to have the losses just booked in case we need them later. A good reason for that would be maybe you don't need to rebalance the account now, but you might need to rebalance it in a year or two, where that gives you the flexibility to do that. Where if you're just kind of making changes to make changes, you're almost losing the losses for that. I think in the end it kind of nets out. I mean, you're going to have the same amount of gains in the end of the account probably, and the same amount of losses if you accumulate them over your entire investment time horizon. It's still going to add up to the same number. That said, in the moment, it's nice to be able to offset things rather than having a big tax bill when you don't necessarily need it.
I guess that's one thing that I think is really helpful to think about is just, so when we trigger capital losses, when we are trying to offset capital gains, but really the goal is for your money to grow long term, it feels like you're just kicking the can down the road. Like, I don't want to pay taxes yet, I want to pay taxes later. Like, what's the point of that? Why?
Yeah, I think the main reason for delaying your capital gains in non-retirement accounts is it's more of the compounding interest principle, where the more money you have in the account, it continues to compound, the better. And so if you're paying a bunch of taxes throughout the time period, like the period, those dollar amounts couldn't compound. I think that's a particular issue if you're if you have a non-retirement account and then you're pulling money out of that to pay your taxes, I think that's really where that would apply.
Pulling it out to pay the taxes.
Yeah,
which
where
some people would have to.
yeah, just depending on the situation. I mean, if you have a ton of gains, that might be what you need to do. And so in that situation, you're hurting your compounding. And so over the long term, it's better to pay all the gains at the end rather than pay them throughout the...
Well, depending on your circumstances, like, I think most doctors are in pretty high tax brackets when they're working. They might be in that 24% capital gains federal bracket right now. They get to retirement, they don't need nearly as much to support their lifestyle. Some of their money's in Roth accounts. They're getting some Social Security. And when odds are in retirement, if you're pulling money out of a brokerage account, a good portion of that is going to be your cost basis, what you contributed. It's not 100% gain.
Exactly.
So, I mean, there's a scenario where you could be living a pretty comfortable lifestyle and effectively have zero capital gains taxes because those lower couple tax brackets, you're taxed at a 0% cap gains rate.
Yeah, exactly.
So, I mean, you're delaying your taxes, and who knows what the future holds with tax rates and everything, but you're potentially paying at a lower rate in retirement than today.
Yeah, exactly. Where I think that's one thing where people avoid realizing gains for so long, and it's like once you're retired, that's the most tax advantaged place almost to pull it out, except for a Roth IRA.
Well, and if you die and leave an inheritance, your heirs get a step up in basis, and whatever the value is at that point in time, that's where their starting point is at.
Yeah, I think that's really important too, is that, explain what that means, Zach, the whole step up in basis. Yeah.
Yeah, so if so say like a parent passes away and they pass on the investments to one of the children, when I can't remember if it's when they die or when it's actually transferred, but it steps up the basis. So say you held a ton of Apple stock and you had bought it for $50,000 and then now it's worth $100,000. If the parent were to sell that, that would be you'd have to pay capital gains tax on $50,000 of that. Where if you get the step in basis, it bumps the cost basis up to the $100,000 that it's at now, and so it essentially avoids capital gains taxes. I mean, you also have the state taxes potentially to deal with and things like that, but depending on the situation.
Do you have any real life scenarios, Corey, where clients have tried to do this or?
Where?
I mean, I've been doing this for 11 years. I started in 2009, so timing couldn't have been more perfect. 2009, market started going up, and it basically never stopped. We've had a couple speed bumps along the way, but we haven't really seen a ton of tax loss harvesting opportunities, at least in domestic stocks. But I mean, this year is a good example. Like I don't know, I haven't run the numbers. Maybe you have, but we've probably harvested well over $1 million of losses for our clients this year, and ultimately we'll save them hundreds of thousands in taxes. Yeah. Again, we'd prefer to just have gains, pay taxes on our gains. You're coming out ahead, but when market goes down and then hits a trampoline and comes back up, you've got an opportunity there to save some taxes and ultimately end up in the same place if you weren't being proactive. So I think it's just hopefully you're either working with a financial advisor that's paying attention to this stuff, or have your money in a tax managed investment portfolio, or you're paying attention yourself because there's opportunities to be had and to lower your tax bill.
And I mean, you never know. Sometimes there's a quick recovery or something like that, but sometimes you could have another pullback, and you have the opportunity to harvest losses twice. Yeah. Where if you're not paying attention to that kind of thing, I think that's the main risk, is if you're not paying attention to it, just not taking advantage of that. I also think that most clients, I think if you were to pull up a statement or something like that, most clients don't know what their actual cost basis is. You almost have to ask specifically for the cost basis, but then even then, the really granular detail, a lot of times people don't even know that exists. So if you're trying to harvest losses, it's hard to do that without having that information, and so that's one of the ways where financial advisor can help.
Yeah, the tax lots are the key. Like that's how you successfully do it to maximize your, I guess, tax lowering abilities and still your investment overall strategy. So anything else, Zach, that you think we didn't cover that would be beneficial for people to know?
I don't think so. I think we did a pretty good job.
If anyone has questions, you know where to find us.
Yes. Enjoy.
We would love to hear your feedback and suggestions for future topics you'd like us to cover. You can get in touch with the show by emailing podcast@thefinitygroup.com or by following Finity Group on Facebook, Twitter, Instagram, LinkedIn, and YouTube at Finity Group LLC.
You can follow me on Twitter at Corey Janoff CFP, Instagram at Corey Janoff, or on LinkedIn under my name, Corey Janoff.
You can follow me on Twitter at Rachelle Finance, or on Instagram, Vanderzanden Rachelle, or on LinkedIn under my name, Rachelle Vanderzanden.
Check out all of the podcast episodes on the finitygroup.com/podcast, on our Finity Group YouTube channel, or your favorite podcast app. And don't forget to check out our financial clarity blog at thefinitygroup.com/blog.
Thanks for listening to this episode of Financial Clarity for Doctors by Finity Group LLC.